All right, so thank you guys for coming over here. I know there's a lot going on today, but I appreciate it. So I'm going to take a little bit of a different approach today. So I know a lot of you are here because you want to hear about different investment opportunities, and there'll be plenty of people that are talking about those today, but I'm going to talk about investors and not investments. And we've got a saying at Morningstar that we're about the investor and not the investment, and that actually is pretty different. And you hear about investments a lot, whether it's an ETF, whether it's a fund, an individual share, if it's a trading platform. You hear about them a lot from the industry, of course, because the industry is trying to sell you something. And that's perfectly fine, but I want to talk about what makes people good investors and how you can use your goals and what you're trying to accomplish to actually evaluate different investment opportunities. So that's the take I'm going to go through today. Start off talking about you, right? That's the most important thing. We don't care about products as investors, we care about outcomes. We're all investing for reasons. We all have goals that we're trying to accomplish. And one of the really important things that you don't hear much from the industry is that there's lots of different ways to be a successful investor. So at conferences like this, you have people come up and they passionately argue about an investing approach, whether they're a value investor, a growth investor, or a passive or active investor. And it's fine for them to have that passion, but as I said, there's lots of different ways to be a successful investor. And it starts with what you're trying to accomplish, and it also starts with the competitive advantage that you have as an investor. So we hear all the time about moats and sustainable competitive advantages when we're talking about companies, and I'm going to talk about that a little bit later. But I also want to talk about competitive advantages that we all have as investors. So if you are out there and you are trading individual shares, even if you're picking ETFs that are more passively managed and you're looking at different asset allocations that are different than the market, you are in essence trying to, not necessarily beat the market, but trying to do something different in order to accomplish your goal. And if you are doing that, you need to think about what your advantage is over other investors. So there are 4 different sources of edge, which is the industry jargon, but 4 different sources of competitive advantage that you can have as an investor. So the first one's informational. So that means that you know something that nobody else knows. Well, in the age of the internet, in the age when information's just distributed instantly, that's probably not something you have. If you do have that, potentially you're going to go to jail because that's insider trading. So informational advantage, we don't really have that. Then there's analytical advantage. So an analytical advantage means that you have the same information, the same data as everyone else, but you do a better job interpreting it. And there's probably a lot of people out there that think they have this advantage, that you're able to go in there and analyze companies better than anyone else. And there's probably a lot of people that think they have that don't actually have that. That's really hard. So that's hard because there's a lot of people out there looking at the share market. And there are certainly different places you can hide, whether you're looking at small caps, whether you're looking potentially in emerging markets, where maybe it's easier to have that advantage, but it's a very difficult thing to do. And I personally have all the kind of window dressing, CFA charter holder and stuff like that a lot of people in the industry have, and I know that I don't have that advantage. I know that I can't do a better job analyzing a company. So there are 2 advantages that I'm going to spend some time talking about today because it's something that anybody in this room, any individual investor can have. And the first one's a behavioral advantage. So we all like to think of ourselves as rational and making rational decisions, but of course we don't. There's all sorts of things that influence the way that we invest. So there are biases that we have, and there's a whole list of them. If you look at behavioral finance, there's this enormous list of biases that influence the way we invest. And then, of course, there's the simple emotions of fear and greed, right? And that makes people not rational, makes people make bad decisions. So to have a behavioral advantage is to try to put structure into place and try to make sure that you are not making those mistakes. And that's one thing that all of us can do. The other thing that we can do as individual investors, and the big advantage we have over professionals, is something that's called structural edge. So basically what we're looking at is all the structures that confine the way somebody invests. And a lot of these are for professionals, right? It's the fact that it's their job. It's their job. A lot of investors, professional investors, are very highly paid. They don't want to lose their job, right, at the end of the day. So they're not just going out there and investing in an unconstrained world. They have all these structures around them that they don't want to go out on a limb, right? You know, it's a lot easier when they're sitting in their boss's office if they have Microsoft in their portfolio than if they go out and buy some obscure company, right? So it's a lot easier to fail conventionally. Nobody's going to get fired by owning Microsoft. And the other thing, of course, is while they're doing this and while they're positioning their portfolio, they all say they're long-term investors. They're not, right? We have the data at Morningstar. It's easy to find. If you look at the turnover in professional portfolios, they turn over basically their entire portfolio, like 95% of funds, in a year, in 18 months. That's not long-term investing. They'll tell you they're long-term investors, right? Because you have to. But it's not long-term investing, but we don't have any of those structural impediments, right? So that's another piece of edge. So if we think about these two pieces of edge and advantages that we have, that all of us can have, we can start thinking about how to evaluate investments, because what do we need to do in order to have both of those advantages accrue to us? Well, we need to go out there and we need to find investments that, number one, are set up for us to achieve our goals. All of those are unique. We need to find investments that we feel an intellectual alignment with, right? An investment approach, an investing strategy that we are totally bought into, right? Because that's going to allow us to, number one, push those emotions away. It's going to allow us to hold something for the long term. And we also have to think of our temperament, right? And that's why different investment strategies resonate with different people, and that's okay. There are different approaches. So personally, I'm pretty boring. My team keeps telling me I'm boring. You can go to our booth afterwards and they'll tell me I'm an old, boring man. I like pretty conservative companies. It's just kind of the way that I invest. And I've recognized that, and I have the self-awareness to know that those are the investments that I'm comfortable with, and those are the investments that I can hold for a long time. So we're going to walk through a couple examples of this. So when you're evaluating an investment, the first thing you need to do is figure out, is this something that works for you? And obviously that means figuring out your goals, figuring out what you need to actually do to accomplish those goals, but it's also thinking about what type of investment it is. That's why if some mate tells you at a barbecue to go buy something, that could be a perfectly good decision for him and her, but it may not be a good decision for you. So I'm going to walk through myself as an example, you know, boring conservative companies, but then just think about yourselves, where you actually fit into this to the spectrum. Because if we start looking at individual companies, and obviously any product that individual companies are rolled up into, an ETF or a fund, if we start looking at individual companies, we start to realize that there are very different levels of business risk in different businesses, right? And that is going to influence how that investment performs. So very simply, if we look at business risk and we think of that as the range of outcomes for a company, we can start thinking about how this applies to evaluating investments. Because the range of outcomes for Coca-Cola on one hand and some biotech startup are very different. Like, we know next year Coca-Cola is not going to double their sales. And we know their sales are not going to fall by half, right? So their business risk profile and that range of outcomes is very different, and that's going to impact the share price. Whereas if you have a small biotech company that's trying to come up with some treatment, looking for approval from governments, well, their range of outcomes could be really, really high on one hand, or they could go out of business if they don't get that approval, right? So start thinking about companies and start thinking about the investment universe. I personally tend to go towards less business risk, but that's just me. And if we start looking at the characteristics of companies, we can start thinking about how they fall in there. So very simply, things you can start looking at is obviously how big the company is. So larger companies obviously operate in more markets. They generally have larger product lines. That means that it's going to be, once again, the range of outcomes is going to be a lot smaller. a localized recession, a localized issue is going to impact them less. If they have multiple product ranges and something goes wrong with one of their products, that's going to impact them less. Whereas if you are a company just operating New South Wales and have one product, that's a very different business profile, right? So that's one thing we can look at. We can look at simple things like, do they pay dividends, right? The fact that a company pays a dividend says a lot about them. Number one, it says they actually make money, which is important. So you have to pay money out, you better make some. That's one thing, but it also tells you a little bit about what they think their prospects are. That returning cash to shareholders is actually a good decision for them because they're not going to grow as fast as maybe a startup would. They need to take any cash they have and invest it back in the business, right? So companies that pay dividends, we can think of those as companies that are lower business risk. We of course can look at their balance sheet. So there's all sorts of different measures we can look at to evaluate a company, but simply looking at perhaps a debt to equity ratio of a company. Companies with more debt, that is risk, right? Just like if you took out a lot of debt, that is risky to you. Same thing with companies, right? So when we went into the pandemic, Australia had 2 major airlines. Well, one went out of business almost immediately. The same thing happened to them, right? They lost basically, temporarily, all of their revenue, but why did Virgin go out of business and Qantas stayed in business? Because they had a ton of debt. Right, so when you're starting to look at those companies, when the future is unknowable, starting to look at those companies, that debt profile really matters. So that's something else you can look at. And then one of the last things you can look at is, and I referred to competitive advantages of investors earlier, but also thinking about the competitive advantages of a company. And whenever we talk about moat or sustainable competitive advantage, you know, it's basically just described, and it is. It's really understanding that industry, but there are ways we can actually tell if a company has moat. So a moat's not just a concept, a moat is something that shows up in the financial statements. So that's something else you can look at. It shows up really in 2 different places. And if we think about capitalism, it is competition, right? It's supposed to benefit us as consumers because we're supposed to get better products. As people compete for you, they'll go out there and invest in trying to create a better product. So that's one thing. And also you're supposed to get cheaper prices because people compete on price. And that's very good for us as consumers, right? We want people competing for us. But as owners of businesses and investors, competition isn't great, right? You don't really want competition, and that's why we're looking for those companies with moats. And companies that are able to withstand that competition, well, they can charge higher prices, and where that shows up on a balance sheet, of course, is the margin. Or sorry, on an income statement is the margin. So you're going to look at the difference between revenue, the top line, so what a company sells a product for, and then of course you're going to look at how much comes out the bottom line, right? So how much is profit? So companies with higher margins, it's an indication that they have a moat because they don't have to compete on price. They don't have to invest as much in their products to constantly innovate those products. So that means they're going to have a higher margin. The other place it shows up is a measure called return on invested capital. And basically what that is a measure of how efficiently and what return does the company get off of money they invest in the business. Right, so what we're looking for there is we're looking for companies that have a return on what they invest in the company that's higher than their cost of capital. And I know I'm throwing around a lot of terms there, but think about this in terms of a small business, right? If you run your own business and you go to the bank and they give you a loan for 7%, so you're paying 7% interest every year. If you're investing that in your business, you better hope you earn more than 7% on that money, right? And that's the same thing with a company. We're looking for a company that can go in there and borrow money or get money from all the different ways they can, whether it's internal cash flow, borrowing money, or raising equity capital. We're looking for a company that goes out there and gets money at, let's say 7%, to use the same example, and invested it, gets 15% return. Because that all accrues to you, right, as shareholders. So that's what we're looking for. So that's another really important measure. So if you want to start evaluating these companies, go in there and look at those 2 measures and compare them to the industry. Go back and look at it over time. Are these measures actually consistent? Because a lot of companies can do this initially, right? If you think about the way this works, you release a new product, that's great, everyone loves your new product, and then everyone else copies you, right? So if you don't have that competitive advantage, all these other companies are going to copy you. And then of course, what happens? Well, you're going to start to see those margins go down. You're going to have to cut your prices. You're going to have to invest in it. So go look at those over time It's another really important measure. So once you start framing companies around what you think your competitive advantage is, for example, a moat goes very well with long-term investing. If you're a trader, you don't care about a moat, right? Because moats could be a couple percent every year that they're investing at a higher rate than they're borrowing, a couple percent every year that accrue to you. You need to own that company for a very long time for that to start to compound and really make a difference. So if you are looking to be a long-term investor, a moat's a pretty good thing. If you're a short-term investor, it doesn't matter, right? You're looking at price action, you're looking at where the next buyer is going to come in. So go in, evaluate companies, think about how that actually works with you, and then of course you have to figure out if it's a good time to buy a company, right? So what analysts generally do, and if you're one of these, if you think you have analytical edge and you want to build a discounted cash flow model to price a company, like go for it. Our analysts do that at Morningstar. I don't personally do that, because once again, I don't think I can do that better than other people. But maybe just looking at the three sources of return can actually help you make that decision if it's a good time to buy that company. So returns come from three places, right? We hear a lot of stuff in investing, a lot of very complicated things, but there's only three ways you're going to get a return. So one is a dividend, right? So that's pretty obvious that you are actually going to get cash payments from your company. So that's one place. The other place we get a return is changes in valuation level, right? So there's lots of different valuation measures, but let's say a price to earnings ratio. Somebody's willing to pay 10 times earnings for a company. Well, if that changes over time, and eventually people want to pay 15 times earnings for that company, that's return, right? That goes to you. And then the third thing, of course, is earnings growth of the company. So those are the only three places. So if you're sitting there evaluating a company, you need to figure out which of those is going to happen. If we look at what's happened in markets this year, right? We've seen those valuation levels go down. We haven't seen a lot of hits to earnings growth yet, but a lot of the fall that's happened has just been those valuation levels coming down. Now, people are very worried, of course. We're going to start to see earnings go backwards as well if various economies move into recessions, but that's simply a valuation drop, right? So someone who bought Tesla on January 1st of this year, for example. So Tesla was trading at about 350 times earnings. Right, so I can tell you one thing, Tesla will not be trading for 350 times earnings 10 years from now, right? Like nothing trades at that valuation level for a really long time, but why do you buy Tesla? You think the earnings growth is going to be so great that it's going to make up for that fall in valuation level. But those are the things you need to think about. Like how fast do earnings have to grow in order to make up for that fall? And I'll go through a very simple example, and because we weren't supposed to use slides today, I did write an article that includes a lot more of this data, so you can follow that QR code or go visit us in our booth and actually read the article. But we can use an example very quickly of where you get this. So personally, I've calculated the return I need to achieve my goals. So I need a 6.9% return for roughly the next 20 years to get to my goals. So I can start backing into that when I start looking at companies. And so if the dividend yields 3%, well, that's great, okay? That's 3% of that. Then I can start thinking, okay, how do I get that roughly 4% I need? Where's it gonna come from? So it's just an example of why you need to sit there and think about, okay, how can I actually get the return I need, understand the return you need, how can I get it, and what are those drivers gonna be? And finally, I wanted to finish off talking a little bit about why this is so important. And we hear about investments all the time, as I said before. And a lot of people will come up and they'll talk about how a share's done, how a fund has done, how an ETF has done. But the real question, of course, is how do you do? And the returns that investors get and the returns that investments get are very, very different. And you may not think they are, but they actually are. And they're different because of poor timing. So Morningstar does a study, and we do this once a year, where we look at investment returns and we look at investor returns. And the way you can separate these is by actually looking at flow data, right? So if you look at a fund, if you look at an ETF, when are people investing in it? And so you can actually calculate that based on that flow data. So we did this in 2021, was the last time we did this survey, and it turns out that investors are trailing investments by 1.7% a year. And that is, of course, bad timing. That is chasing performance, that's churning your portfolio, that's investing in the great new ETF that's been released. And that 1.7% is a lot. It may not sound like a lot, but if you're a 25-year-old and you are lucky enough to have $50,000, you don't put anything else into your account, let's say you get an 8% return. So 40 years, when you're 65, maybe you're thinking about retiring, so you've got $1.1 million if you have 8%, so pretty good, right? So you subtract 1.7% from that. So you're at 6.3% now. You've got about $575,000. So that's a huge difference, and that doesn't actually even account for all of the problems. It doesn't account for the taxes you're going to pay if you're continually turning on your portfolio. It doesn't account for all the transaction fees. So this can make the difference between achieving your goal and not achieving your goal. And what this is it's poor timing. It's not understanding the types of investments that resonate with you and holding them for multi-decade periods. And that's the secret to investing, right? It's not sitting there and looking at the latest new ETF, the latest product that comes out. Find something that's comfortable for you. Have the self-awareness to understand what those investments are. And it takes time to figure out maybe the investment strategy and the types of investments that resonate with you. But the first way you can do this is start thinking about where those investments that you're going into, where they fit on that scale in terms of business risk. Because that's going to impact volatility, it's going to impact lots of things that may not matter over the long term, but probably are going to influence your behavior in terms of how long you're going to hold on to that investment. So anyway, that is everything. I'm out of time, but I did want to thank you guys. Please come visit us in the booth. We'll be hanging out there all afternoon. And yeah, if you want a little more information on some of the stuff I talked about, we have a QR code at our booth and of course there, so read the article, and you can listen to our podcast, Investing Compass, as well. But anyway, thank you guys very much. I hope you guys have a great day.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.